In this video, we turn our focus to Vietnam, where strong first half momentum, tariff headwinds, and ongoing reform efforts are shaping the narrative for the rest of this year. The July US-Vietnam trade agreement marked a key milestone in bilateral relations. Vietnam secured a 20% reciprocal tariff under the new framework, down from the initially proposed 46% levy in April. While Indonesia later secured a slightly lower rate of 19%, Vietnam's deal still represents a relatively favorable outcome, especially in light of the ongoing global trade tensions. However, the deal also introduced a new complexity. Exports considered transshipments will face a 40% tariffs. With no clear official definition yet, investors and businesses remain cautious, particularly firms involved in re-exports or those sourcing components from regional supply chains. Clarifying this rule will be crucial for Vietnam's continued attractiveness as a manufacturing hub. Despite these uncertainties, Vietnam posted stronger than expected growth in the first half of this year. GDP rose to 8% in the second quarter, up from 7% in the first quarter, bringing the first half 2025 average to 7.5%. This broad-based expansion, partly driven by manufacturing, which grew by 10.7% in the second quarter and contribute 2.5 percentage points to the headline growth. As a result, we have revised our full year 2025 GDP growth upward to 6.3% from 5.5%. This implies growth moderation in the second half as front-loading fades and the impact of higher tariffs begins to set in. Indeed, electronics and electrical exports, which accounts for more than a third of total exports, have slowed to 22.4% year-on-year in June from 30.6% in May. Textile and footwear exports also softened after a strong performance earlier this year. On the domestic side, retail sales growth eased to 8.3% in June from 10.2% in May, with broad-based weaknesses in the goods, accommodation, and tourism-related spending. Still, Vietnam industrial production held up, expanding by 10.0% in June. Business sentiment remains resilient, with Eurocham's latest survey showing 72% of European firms continue to recommend Vietnam as an investment destination, despite global uncertainties. To support domestic demand, authorities have expanded the reduced 8% VAT rate through end 2026. Major structural reforms have also been passed, including the consolidation of provincial governments and legislative changes to improve private sector access to land, credit, and digital infrastructure. On the infrastructure front, the government approved a high-speed rail link between Hanoi and Ho Chi Minh City, the Lao Chai and Hai Phong Railway, and full tuition exemptions for students through grade 12. On the monetary side, the State Bank of Vietnam has kept rates steady in the face of currency volatility. With growth risk now appearing more manageable, we have pushed our forecast for a 50 basis point rate cut to 2026 instead of the second half of this year. On net, Vietnam enters the second half of this year on a strong footing. Growth has exceeded expectations and reform momentum remains robust. However, global headwinds and tariff-related challenges suggest a more measured pace going forward. The key will be effective policy execution to ensure continued resilience and broad-based growth.